Something changed this month. Not a rumor. Not a political talking point. Not speculation from someone on the internet trying to get your attention. An official government report was released on June 9, 2026. Published by the United States Treasury Department and the Social Security Administration. Signed by federal trustees. Based on verified financial data. And what it says about the next 7 years of your retirement income is something every American over 60 needs to understand right now, before July arrives and two separate financial pressures land on your household at the same time. This is not about panic. This is about facts. And the facts changed last week in a way that most television news programs summarized in 30 seconds and moved on from. You deserve the full picture. The first piece of news involves a clock. A countdown that just moved closer. And a number, 22%, that represents the single largest potential cut to retirement income that most living Americans have ever faced. The second piece of news involves your monthly check. Specifically, what happened to it in January when the 2.8% COLA increase arrived, and why, for millions of seniors, the check that was supposed to go up actually went down in terms of what it could buy. Both of these developments are real. Both of them affect you directly. And understanding them clearly, not in headlines, not in political framing, but in plain numbers, is the only way to make decisions about your retirement income that hold up over the next several years. On June 9th, the Social Security Board of Trustees released its 2026 annual report on the financial health of the Social Security program. The headline number from that report is 2032. That is the year the trustees now project the Old Age and Survivors Insurance Trust Fund, the fund that pays your monthly retirement benefit, will run out of reserves. That date moved. Last year's report projected the first quarter of 2033. This year's report moved it to the fourth quarter of 2032. One full quarter closer. And according to the Center on Budget and Policy Priorities, which analyzed the report within 24 hours of its release, this is the second consecutive year the depletion date has moved in the wrong direction. The reason it moved is documented in the report itself. The One Big Beautiful Bill signed into law in 2025 reduced the amount of income tax that Social Security beneficiaries pay on their benefits. That reduction was real and it benefited seniors in the short term. But it also meant less money flowing back into the Social Security Trust Fund, because a portion of Social Security benefit taxes are recycled back into the system. Less taxation on benefits means less revenue returning to the fund. Less revenue means faster depletion. According to the Center on Budget and Policy Priorities, raising the standard deduction for seniors' reduced income into Social Security's trust funds by nearly $170 billion over 10 years. That is not an abstract projection. That is $170 billion that the system counted on and will no longer receive, accelerating the timeline to 2032. Now here's what 2032 actually means, because the way it is reported in most news coverage leaves people with an incomplete and sometimes misleading understanding. The trust fund running out of reserves does not mean Social Security disappears. The program will still collect payroll taxes from every working American in 2032. What it means is that those incoming payroll taxes alone are only projected to cover approximately 78% of what beneficiaries are owed. The remaining 22%, the portion currently covered by drawing down the trust fund reserves, will no longer have a funding source unless Congress acts. Under current law, Social Security cannot borrow. It cannot run a deficit. Cannot pay more than it takes in. So if Congress does nothing between now and 2032, benefits are automatically cut across the board, for every recipient, regardless of age, health, income, or how long they have been collecting. According to the American Enterprise Institute's analysis published within days of the trustees' report, the automatic cut triggered by trust fund depletion would be 22% for the Retirement and Survivors Fund. On the current average Social Security benefit of $2,071 per month, a 22% cut is $456 less every single month. For someone receiving $1,500 per month, it is $330 less. For someone receiving $2,500 per month, it is $550 less. These are not projections about what might happen to someone else in a distant future. This is a mathematical projection about what happens to every current Social Security recipient in fewer than 7 years if Congress takes no action. The American Academy of Actuaries issued a statement within 24 hours of the report's release noting that the window for gradual, manageable reform is narrowing, and that every year of delay makes the eventual solution more painful and more abrupt. Congress has received similar warnings every year for over 2 decades. They have not acted. Here is what makes the 2032 date feel more urgent than any previous warning, and why this particular trustee's report carries more weight than the ones that came before it. 4 years. The depletion date was far enough out that it felt theoretical. A problem for a future Congress. A crisis that would arrive on someone else's watch. Politicians on both sides of the aisle found it easier to acknowledge the problem and defer the solution than to accept the political cost of fixing it. That calculation is changing. The Congressional Budget Office published its own estimates in February 2026 showing a worsening financial outlook compared with the prior year. The trustees' report released June 9th moved the date again. The Social Security actuarial imbalance, the official measure of the long-run funding gap, grew from negative 3.82% of taxable payroll last year to negative 4.42% this year, according to AEI's analysis. The hole Congress will have to fill is getting larger every year they wait. And the range of solutions available is narrowing. For decades, proponents of a revenue-only solution argued that simply removing the cap on taxable earnings, currently $184,500 in 2026, would solve the problem. The math no longer supports that claim. According to the American Enterprise Institute's June 2026 analysis, removing the earnings cap entirely would fill only about half of the current funding gap and only 1/3 of the long-run gap. Benefit cuts are now, in the language of the report's own analysis, clearly on the table. That is a significant shift. And it means the seniors who will be least affected by whatever combination of solutions Congress eventually adopts are the ones who have already thought through what a 22% cut would mean for their specific monthly budget, and who have not built a retirement plan that falls apart if that number materializes. The second development that directly affects your money right now does not involve a future date. It is already happening. And it has been quietly eroding the value of your Social Security check every single month of 2026. In January, the 2.8% cost of living adjustment took effect. The Social Security Administration announced that the average monthly benefit would rise from $2,015 to $2,071, an increase of $56 per month. That is the headline number. Here is what actually arrived in most seniors' bank accounts. Medicare Part B premiums increased at the same time. The standard monthly premium rose from $185 in 2025 to $202.90 in 2026, an increase of $17.90 per month. For most Medicare enrollees, that premium is deducted directly from their Social Security payment before it is deposited. The net result: the $56 COLA increase minus the $17.90 premium increase leaves a real-world net gain of approximately $38 per month for the typical beneficiary. $38. That is what most seniors actually receive from a 2.8% cost of living adjustment in a year when energy costs, food prices, and healthcare expenses continue to climb. And for higher-income retirees subject to IRMAA surcharges, the income-related Medicare premium adjustment, the picture is worse. According to AOL Finance's June 2026 analysis, IRMAA brackets in 2026 were adjusted by only about 3%, while the surcharge amounts themselves climbed by roughly 9%. A retiree just over the single filer threshold of $109,000 now pays approximately $284 per month for Part B instead of the standard $202.90, roughly $80 more per month than the base premium. At the highest income levels, the Part B premium alone reaches $689.90 per month. Those amounts are deducted from Social Security before it reaches your account. The Motley Fool's March 2026 analysis put it plainly: a lot of retirees could end up having a hard time making ends meet and covering recurring expenses, precisely because the COLA that was announced sounded meaningful, but the net amount deposited into bank accounts after Medicare deductions was far less than most people expected. There is a third layer to what is happening right now that has received almost no coverage, and that directly affects anyone who needs to contact Social Security, either to resolve a benefit question, correct an earnings record, or navigate the WEP and GPO corrections that are still being processed. The Social Security Administration has lost approximately 7,500 employees between January 2025 and January 2026 as part of broader federal workforce reductions. That represents roughly 13% of the agency's total staff. Dozens of field offices have closed or gone phone-only. Staffing is now at a 50-year low. According to Budget Seniors analysis published in June 2026, this happened at exactly the moment that demand for SSA services has never been higher. Approximately 69 million Americans currently receive monthly payments, a number that grows every month as baby boomers continue aging into retirement. Processing times for disability claims, survivor benefit applications, and benefit corrections have increased significantly. Wait times on the SSA's main phone line have extended well beyond what most callers expect. For seniors who have pending actions with the Social Security Administration, whether checking on a WEP or GPO correction, disputing an earnings record, or applying for benefits they may have recently become eligible for, the practical message is this: do not wait for mail and do not assume a phone call will be resolved quickly. The SSA.gov online portal is currently the fastest path for checking benefit status, payment history, and pending actions. Online requests are being processed on a different track than mail and phone inquiries, and for straightforward status checks, the difference in response time is significant. Now the forward-looking question, the one that actually matters for how you manage your retirement income from this point forward. What does a responsible person do with this information? The first answer is the one that the trustees' report itself is most explicit about. Nothing changes today. Your benefit for July is the same benefit you received in June. The trust fund depletion date is 2032. Not this summer, not next year, not the year after. There is no emergency action required right now. But the second answer is more important, and it is the one most financial planning guidance dances around rather than stating directly. Planning a retirement income strategy around the assumption that your full scheduled Social Security benefit will arrive every month for the next 20 or 30 years is now a demonstrably optimistic assumption. Not because cuts are certain, Congress may act before 2032, but because the government's own trustees are telling you that without action, the automatic cut is 22%. Planning as though that number does not exist is choosing not to look at information that is sitting in front of you. The practical implication depends entirely on your situation. If Social Security represents 100% of your income, and according to a 2026 survey by the Senior Citizens League, 44% of retirees, representing 24.8 million Americans, now report depending on Social Security for their entire income, then a 22% cut is not an abstraction. It is a direct threat to your ability to cover housing, food, utilities, and health care. For people in that situation, the most useful response is not panic, it is awareness, followed by a review of every available supplemental benefit they may qualify for. Medicare Savings Programs, LIHEAP Energy Assistance, SNAP Benefits, Property Tax Exemptions. Programs that exist specifically to provide a floor under seniors whose primary income is Social Security. If Social Security represents a portion of your income alongside savings, a pension, or other assets, the relevant question is whether your plan accounts for a reduced Social Security amount and whether the other income sources are sufficient to maintain your standard of living if the benefit is cut. That is a question worth answering now, clearly, rather than discovering the answer in 2032. There is also forward-looking news on the COLA front that deserves attention, because while the 2026 COLA delivered a net $38 increase after Medicare deductions, early estimates for the 2027 COLA are running significantly higher. As of May 2026, the CPIW, the Consumer Price Index measurement used to calculate Social Security COLA, is running at 4.4% year-over-year, driven primarily by energy costs. Gasoline and utility prices have risen sharply. Food prices continue to climb faster than the headline numbers suggest. Independent Social Security and Medicare policy analyst Mary Johnson updated her 2027 COLA estimate in June to 4.7%. The Senior Citizens League is projecting 3.8%. Both estimates represent a significant increase over the 2.8% COLA of 2026, and in dollar terms, a 4.7% adjustment on the current average benefit of $2,071 would add approximately $97 per month before Medicare premium adjustments. The important context: a higher COLA is not unambiguously good news. A higher COLA means inflation is running faster. The 2026 COLA added $56 to the average check while real purchasing costs rose by an estimated $94 per month to maintain the same standard of living. The gap between what the adjustment covered and what inflation actually cost ran to roughly $38 per month, every month, throughout 2026. A higher 2027 COLA means a larger number on your benefit statement. Whether it covers the actual rise in your living costs depends on what specifically drives inflation between now and September 2026, when the 3 measurement months that determine the official COLA are recorded. The official announcement comes in October. 5 months of data still need to come in before that number is final. What is useful to know right now is that the trajectory is upward, and that for anyone whose monthly budget has been stretched by the gap between last year's COLA and actual cost increases, relief may be coming. Just not yet. And not without the Medicare premium adjustment that will, again, take a share of whatever increase arrives. Here is where everything lands. The June 9th Trustees Report moved the Social Security depletion date to the fourth quarter of 2032. It confirmed that without congressional action, a 22% automatic benefit cut is the mathematical outcome under current law. It documented that the One Big Beautiful Bill's senior tax provisions accelerated the timeline by reducing system revenue. And it noted that the long-run funding gap grew again this year, making the eventual solution larger and harder the longer it is delayed. Your 2026 COLA delivered a net $38 per month after Medicare premium increases consumed the rest, while your actual cost of living rose by more than that. And 44% of American seniors are now reporting that Social Security is their only income, a number that climbed 5 percentage points in a single year. July does not bring a cut. It does not bring an emergency. What it brings is a moment where everything that is currently in motion becomes slightly more visible than it was before. The clock is running. The numbers are real. And the seniors who come through the next several years with the most stability will be the ones who looked at this information clearly and made decisions with open eyes. This video is for educational and informational purposes only and does not constitute financial, tax, or legal advice. All information is sourced from the 2026 Social Security Trustees Report, the Center on Budget and Policy Priorities, the American Enterprise Institute, AARP, the Senior Citizens League, Budget Seniors, and other publicly available sources current as of June 2026. Social Security rules, benefit amounts, and projections are subject to change. Always consult a licensed financial advisor or Social Security planning specialist before making decisions about your benefits.